Hey there. I've been meaning to make an introductory video to my COT reports for a while now, and I just finished updating a new slide that I liked so much I thought it would make the perfect intro for this. If you're curious about why you should care about the COT, then look no further than this next slide. These two charts show Coffee's COT report graph first price. The top chart is a 6-month, and the bottom chart is expanded out to 5 years. The net spec position is in blue. The futures price is in gray. You can see how beautifully they track each other, and when I ran the correlation, it's about 80% for both time periods. Clearly, there's a big connection between price and positioning. Over the next few minutes, I'll provide a brief introduction to what the COT is, and then offer some insights into how to interpret the data. So what is the COT report? Simply put, the COT report answers an important question. Who is in the market? There are three primary versions of the COT: the legacy, supplemental, and disaggregated. Each of these attempts to answer this question in slightly different ways. The original, or legacy, COT report provides the simplest answer to this question with two blunt categories: commercials and non-commercials. Commercials are market participants who use the futures market for hedging purposes. They either trade or consume a physical commodity and offset that physical price exposure with a corresponding futures market position. In the coffee markets, this includes trade houses, farmer co-ops, and roasters. Non-commercials are often thought of as the bad guy of the report because their positions are speculative. They buy the commodity when they think that the price will go up, and they sell the commodity when they believe the price will go down. These are typically hedge funds and mutual funds, but can also include private individuals. Although we have additional classifications in the newer COT reports, these two categories form the fundamental dynamic for understanding positioning in the market. Additionally, the legacy version has data going back the farthest, so it's still very useful for looking at longer-term time trends or specific periods of historical data. The next report to be introduced was the CIT, or supplemental version. We've noted that the non-commercials, or specs, are often thought of as the antagonist, but in the late 90s and early 2000s, a new bad guy appeared on the scene: index funds. Index funds frustrate and excite market participants because it is a flow of money that is completely divorced from the supply and demand of that particular market. Traders become worried about the effects of this uncorrelated capital flow in the futures market, and by 2007, the CFTC began issuing a supplemental COT report that adds the index fund category in addition to the commercials and the non-commercials. This supplemental report is called the Commitment of Index Traders, or CIT. The most recent version to be released was the disaggregated COT report. The disaggregated COT was started in 2009 and reflects another change in the markets: the appearance of swap dealers. It's called disaggregated because the swap dealers have been disaggregated from both the commercials and the non-commercials into their own category. There are four categories in the disaggregated COT. Managed money, which is basically identical to the non-commercials, but specifically refers to institutional investors. Producers, merchants, and processors, aptly named. This was previously commercials, but for coffee specifically, we're talking about roasters, trade, and farmer co-ops. And then we have swap dealers. This is new. This includes some index funds, but also includes swap dealers who sell OTC products and then hedge their risk in the futures and options market. Lastly, we have other reportables. This includes individual speculative traders, those who don't manage other people's money, and also some index funds that place orders directly in the market, not through swaps. So now that we know what the categories are, let's take a look at the report itself and see what it actually tells us about who is in the market. So this is what the report looks like. As you can see, it has the total open interest, the participant categories, and the long and the short for each category. The values on this report are static. It's like a snapshot in time. And much like a snapshot, this picture can tell you a lot about what is going on. To understand what this picture can tell you about the market, we need to consider the motivations of the major parties. The commercial shorts are the trade. They bought the physical coffee from farmers, and they're going to hedge their coffee at the highest price possible. This means that when prices are high, the commercial short will sell more. The commercial longs sell physical coffee in their business, and they hedge their purchasing needs by acquiring futures when prices are low. This means that when prices are low, commercial longs will buy more. Here we can see the commercial shorts on the left, commercial longs on the right. When prices are high, you see that commercial shorts sell more. When prices are low, the commercial longs are buying more. The commercials must trade coffee futures to hedge their coffee operations, but the speculator, on the other hand, has a choice in which commodity to trade. The specs follow price and jump in only when they are exciting enough to present an opportunity. Most often this manifests itself as trend following. When prices are high, the spec jumps in on the long side and takes a long position. When prices are low, the spec is very short. So when we look at an expensive market, we would expect the commercial position to be very short and the spec position to be very long. When we see a cheap market, we would expect the opposite, the commercial position to be very long and the spec position to be very short. Although the snapshot can tell you some interesting things about the market participants and the price, the real story becomes apparent when we look at the changes in the COT over time. This turns your snapshot into a movie. It comes alive with a dramatic story dominated by emotion. Trading in a market is incredibly emotional because underneath the labels, the market participants are people. Fortunes are made and lost, companies can go bust, and the livelihoods of thousands of people are on the line. The angle of this graph can provide a clue as to the emotions involved. When fear and greed are involved, the angle will be steep as participants scramble over each other to trade in the market. The longer the time frame included in your graph, the longer the story, and the greater your perspective. Expanding the graph outward and looking at the longer-term story, you can see evidence of a larger phenomenon, seasonality. There are several cycles in the physical world that impact the seasonality of coffee in the financial world. These in turn affect the COT positioning, and with coffee specifically, the most important is the crop cycle. To observe how the crop cycle affects positioning, we use a seasonal chart. This is a calendar year seasonal here, so we overlay the positioning year over year beginning with January. You'll also find seasonals based on the crop year, which is sometimes more useful. The coffee crop year is October through September, so if this were a crop year seasonal, it would begin with the start of the crop year in October. We get an idea of the seasonality of the various positions by taking the average value on a certain week of the year for the past several years. Since coffee is grown on both sides of the equator, there are two different coffee harvesting seasons, the winter crop and the summer crop. The winter crops are harvested October through February, and the summer crops are harvested between April and August. Since the farmer is often selling his crops heaviest at those times, we see the commercial short positions increase during that time as trade houses buy up the physical coffee and hedge in the futures market. Also note that the largest producer of coffee, Brazil, is most vulnerable to frost in July. Here you can see the average spec position increasing during that period as speculators build long positions around that time in anticipation or reaction to frost. The next thing we want to look for are trends. Trends are very easy to see in retrospect, but much more difficult to predict. One very well established trend is that the population of the world is growing, and the amount of money in the world is also increasing. So we see a general trend of higher open interest year over year as the amount of coffee that is grown, traded, and consumed increases. We can see this by looking at the difference between the 5 and 10-year averages. Other trends are more micro and specific to an event. The commercial short might sell into a rally, or the specs might be unwinding a large short position. Looking at the directional changes on the chart will give an indication of if this is happening, and support and resistance levels will suggest where we might expect a turning point. Support and resistance levels exist because some positions are sticky. Let's look at support first. Commercial shorts and the commercial longs exist as a hedge, so they never go to zero. They have a functional zero, which is their historical minimum. This minimum reflects the minimum amount of hedging that they are required to have. The spec is not required to have a position on in coffee, but given that there are both contrarians and trend followers, some percentage of specs will almost always have a position on. So in both the spec and the commercial positions, we can look at what the historically low levels are and use those as the zero position, which would form some support. In addition to support, we can also look at the historic highs and use that as a max position, at which point the market participant would not put on any more positions. For the commercials, this might mean that all of their hedging is completed. For the spec, it could mean that they don't have any more cash to buy or sell more futures. A word of caution. You need to be very careful when trying to call a max position for at least two reasons. First, as we noted earlier, the supply of coffee and money has been increasing steadily every year, so the max is always increasing. Second, with the spec position, if the spec is correct, in other words, long in a bull market or short in a bear market, then he's gaining more money through margin, and therefore he can use his earnings to increase his position. All of this is to say that the max position can increase more than you might expect. My final point here is to reiterate that when using the COT, you want to be thinking about the motivations and limitations of the market participants. When looking at the commercials, they tend to be less aggressive in putting on positions. They're not excitedly throwing market orders out based on a trend or a whim. They're using limit orders and GTCs to hedge physical positions. Since they are more deliberate and using futures as a hedge, the commercials tend to be less susceptible to being knocked out of positions during an adverse price movement. However, there are important exceptions. Take commercial longs, for example. Longs like to buy when prices are cheap, and they stop buying when prices rise. In 2016, commercial longs were following this relationship as per usual, and as prices rose, they dropped to historically low levels of futures coverage. This made the roasters nervous, so with a little bit of a hedge on, with no hedge on, they decided to buy more, and they ended up buying into the highs of the market here. Once they capitulated, the relationship resumed as normal, and as prices decreased, roaster coverage increased. The specs, by contrast, tend to be more aggressive in putting on positions, and may even intentionally try to move the market with their orders. Since the specs are aggressive, whenever we see large price movements, we tend to attribute it to the specs. Although the spec is more aggressive, their positions are considered weaker. The weakness of the spec position derives from their speculative nature. If a spec puts on a long position, prices fall, there's no hedge to offset the loss. If the position loses enough money, the specs will be forced to liquidate. Specs often place stop orders around their positions, and if many specs put orders around the same place, we can see dramatic reversals in price action. Anticipating dramatic moves like these are the reason that many traders place so much stock in the COT, but you have to think beyond what positions are on, and think about why the positions are on. Consider the vulnerabilities and motivations that induces the players to put these positions on, and how price movements will affect them, especially when positioning is at the extremes. The COT is not a magic bullet. It's one tool in your toolbox to understand the market. It's important to understand because it provides a layer of transparency on the participants in the market. Be careful when making trading decisions based on the COT. The market defies complacency, and when the conventional wisdom becomes too conventional, the market tends to surprise. Despite all of this, the COT report provides a baseline of transparency that we all share. It is one of those few data points in the coffee world that is undeniable but also open to interpretation. The COT has been an important component in market transparency for a century, and we can expect it to be important for the next century because it answers that essential question: who is in the market? The answer to that will be key for smart traders as they aid the market in price discovery.